What's up and welcome to my channel. I recommend you to also take a look at my other channel, which is Edward Excel. I share a lot of interesting things. With that being said, a lot of traders think that smart money make them profitable. I recommend to pay close attention to all the things that are shared in my channel right here, whether they are the shorts or the videos or also the written things that I share and most people don't take a look at. I recommend you to take a look at these things because a lot of people, as I said already, think that smart money makes you profitable. But why? If everyone knows about smart money, why is not everyone profitable yet? Why are 95% of the traders still losing money? This doesn't make sense because it seems like smart money is the holy grail, but at the same time, 95% of the people are still losing money. Of course, it can be a mindset problem. Of course, it can be, not good risk management and a lot of other things. But at the same time, it looks like smart money doesn't really work. Is that really it? I'm not sure. Actually, I am. I know that, I know for sure that you need to have a statistical edge when you are trading. Smart money doesn't make you profitable. My strategy has some concepts of smart money. It actually has many concepts that are put together and many others that I don't really take a look at. The reason why is because you need to find a statistical edge on the market, whether it is with smart money or with other things, and you need to make sure that your strategy is back-tested and works statistically. We are here, and I am here in this channel to show you concepts that are making me profitable. So, with that being said, let's get started.
Hello traders, welcome to the new episode of Forex Excel. Usually we place our orders at important levels in the chart. We buy in demand zone and sell in supply zone. But what if this demand and supply are not important enough to place a trade? Probably we will end up losing if we execute a trade on it. In this episode, we will cover one of the most powerful demand and supply zones called order block. We will show you how to draw order blocks on the charts along with the rules to identify valid order block. Let's get started. So what is an order block? Order block is the final candle before an impulsive move that leads to a break in a market structure. This is basically means the most recent higher high gets taken out or the most recent lower low gets taken out. Price must break structure to be valid. It is a fancy word for supply and demand, where large institutions have placed big orders at these areas in the market. It is formed when there is an imbalance formed between the buyers and sellers in the market. When the price reaches them, we can expect the price to show a significant reaction to them. There are two types of order block. Bullish order block is the last down candle before a bullish, impulsive move to the upside that breaks structure. As you can see on the image, it is in a bullish trend. We will see a large momentum to the upside, which usually leaves behind some imbalance. Let's take a look at this example and see if we can identify the order blocks. Here we have bullish trend, and you can point out the drastic moves caused by market imbalance between the buyers and sellers. So by definition of order block, you can check and you can spot one. The next type of order block is a bearish order block. A bearish order block is the last up candle before a bearish impulsive move to the downside that breaks structure. Here in our example, you can see a bearish trend, and you will see a large momentum to the downside, which usually leaves behind some price imbalance. So far, you know a vision of order block. Order block must meet 4 rules to work effectively. We already discussed the imbalance earlier. So the second rule is to see break of structure. So a break of structure is when the price made a move to the downside or upside and make a new low or a new high or break a structural level. And you will see a pullback as well. The third rule is inefficiency. If you take a look on this example, in the first case, the price went up to this level and then pulled back, and gather all the orders that have been waiting for a pullback. This will have a minor chance and work because there's no existing orders since all of them have been gathered before. On the other scenario, if someone waiting for a pullback, they will have a miss on the trade because everyone is waiting to place orders in the demand zone. This is the concept of inefficiency. The last rule is unmitigated. Order block is one-time use, and we don't consider placing a trade if it's hitting the demand or supply zone more than once. So that's it, traders. Thanks for watching. Please support us by like and subscribe, and comment down below if you have any questions. See you in the next video.